Welcome to Peirpoint Perspectives, the securities finance podcast delivering commentary from the best, brightest and most innovative people in the world of securities lending, repo, collateral management and related areas. Peirpoint Perspectives is brought to you by the consulting team at Peirpoint Financial. So now, over to your hosts.
Hello and welcome to episode 6 of Peirpoint Perspectives. I'm your host Roy Zimmerhansel and practice lead at Peirpoint. Today we're going to look at Collateral, a historically undervalued and under-realized part of the capital markets. My guest today has been dealing with derivatives and collateral for over 20 years and has been based in Australia, Singapore, and the UK, where he's been for most of his career. In an interview he gave when he joined as managing partner at his current firm, he said, "I firmly believe that the time for collateral to be treated as a front-to-back product in its own right is here." Well, of course, I couldn't agree more. Every specialist journal covering the uncleared margin regulation talks to my guest and his firm, as do many companies that are coming to grips with the collateralized world we live in today and probably forever. He's such an expert on collateral that if there's a webinar out there on the topic and doesn't include my guest, then I'd wonder about its credibility. He and his colleagues have created a concept whose name I love. It's the famous Wheel of Pain, and I'm hoping he'll tell us more about that today. My guest and the founding partner of his firm can be found on LinkedIn, Twitter, and Facebook, maybe more places, and I'll include links in the show notes. I love the LinkedIn stuff they do, as they often get video clips unrelated to collateral management and instead often find inspiring and sometimes funny clips. I think it's worth following them on LinkedIn just to see those. The final item of note is that they've recently been featured on the Is the New Member Showcase page, and I think that's a great testament to what the community thinks of the professionals at the firm. So without further ado, let me introduce my guest, Sean Murray. Hello, Sean, and welcome.
Hello, Roy. Thank you very much for having me. Looking very much to a great conversation here, trying to get some fun in and out of around collateral, which is what we're all about, and it's obviously some seriousness as well as we talk about some of the client challenges and some of the concerns that people have got.
Well, Sean, listen, that's the plan, but the reality is possibly only you and I can find the words collateral and fun all in the same sentence. But we'll let listeners decide on that. Look, thanks very much for being on today's show. I know how busy you are. I have 1,000 questions I want to ask, but we'll probably only get to 400 or 500 of them. Look, I know why I asked you to be on the show, but why do you think listeners should be interested in this episode?
Collateral management has been a trend for over a decade. We've had multiple regulatory mandates, the evolution of the collateral ecosystem, and efficiency in margin processing, which sounds great if you want to do the minimum to comply. The reality is, though, that this probably isn't enough. It's complicated, and you need to understand how to simplify and reduce your costs to be more efficient with your dollars and your resources. And that's what I'm hoping to explore with you today.
Great. Well, let's get on the journey of exploration. Let's start at the start. Uncleared margin regulations, right? So where are we? The reality is, this isn't a new thing, is it? But it's a journey. What's the current status? Where are we going? What's the state of play? Maybe we can start with that.
Yeah, sure. State of play is that you're right. It's not a new thing. It's been around now for coming up to a decade by the time we get to 2022. We have had another extension from the regulatory bodies. Well, let's rephrase that, BCBS, IOSCO, the regulatory bodies, each regulatory jurisdiction, so the EU, and Australia, Hong Kong, Singapore, they're all now evaluating that. Most have come out with a description that they are very happy to support an extension. So we just need that to be ratified through the various regulatory passages that they go through. So, for example, in Europe, it will be through the European Commission. What has happened? So phase 5, which is the next phase to go live, is due to now go live on the 1st of September 2021 rather than this year. So they got another 12-month extension, so it left them with 18 months to go live. Phase 6, which is the smallest counterparties impacted by UMR, actually now due to go live on the 1st of September 2022. So in effect, they still have 30 odd months, just under 30 months to get ready for the go live process. So very broadly, the market has sort of split, I guess, into two different camps. One where, for the phase fives particularly, where clients were very much ahead of the curve, and they were doing the documentation, they were doing the connectivity into the collateral ecosystem, they were talking to the dealers, talking to the custodians, getting onboarded, going through the negotiation process. For those guys, it's a bit painful. They really now are in a situation where they've got teams, they've got funding, they've got the bodies around them to do what they need to do, but they're slightly hamstrung because you don't want to drag this out for another 15 months. The other camp, of course, is the guys who are not, and the clients who are not quite as ready, maybe hadn't put as much into the thinking behind how they were going to get compliant and what they needed to do to get compliant, hadn't started any of the documentation or the onboarding processes or even their projects internally. For those clients, it's a bit of a godsend. So I'm not completely sure right now whether I think it's a positive or a negative. I will sit on the fence a little bit and just say I think it's good for some and bad for others, because it seems to be more problematic for the people that were the clients that were doing were more advanced in their project implementation, shall we say, and getting ready. For those guys, there's more to sort out than for the people the clients who weren't quite as focused or advanced in their journey.
Great. So let's just pause there, because there's quite a lot in the message you've just given us. So let's start with, I guess, as the phases themselves describe it, it's a 6-phase process. So that would suggest to an outside observer that, excuse me, that most people have already been captured. If the only people left are phases 5 and 6, then surely 1 to 4 has captured the majority of users. So maybe you can give us some idea on the scope of who's already in, who this next phase is likely to capture, and then phase 6, just to give some perspective.
Sure, it's a good point, Roy. And for the uninitiated, probably worthwhile clarifying. So the way the UMR has operated is on a threshold, and the threshold has reduced over different phases. So phase 1 was the biggest dealers, so the big dealers, the liquidity providers, the tier 1 organisations. Tier 2, tier 3, generally banks. Phase 2, phase 3, apologies. Phase 4 saw the first buy-side clients or counterparty come into that phase. So phase 5, phase 6 is really the much smaller organisations and the buy-side coming into, so it could be asset managers, investment managers, insurers, coming into the UMR realm. So actually, these are the guys the clients that had the clearing exemptions in some instances. They're people that have become impacted by clearing and in later phases as well. So it ties in with other regulations. We've seen it in the model itself has been comparative to the size of your organisation, and I guess its importance from a global economy perspective. Phase 5, and so within the first 4 phases, I think I could probably say 150, maybe 200 counterparties. I don't know off the top of my head, but that would be my estimation. Phase 5 is coming into, in phase 6, where we move into the smaller counterparty world. We're up to, based on ISDA analysis, looking at around 1,100 counterparties. And that analysis has been split. So we have about 300 impacted counterparties in phase 5 and about 800 in phase 6. So what does that actually mean? Well, it means that phase 5 alone is significantly larger than the first 4 phases combined. And then phase 6, you're going to triple that again. So the problem is not that the people don't understand what they're doing in the first 4 phases. They do. They've gone through it. They've gone through the process, particularly in phases 1 and 2 now for 3 or 4 years. The problem and the issues are that some of the understanding of UMR and the complexities of UMR, because it is a complex regulation, it's 80 pages of technical standards in EU alone, and there's 13 jurisdictions or so you've got to understand. For the phase 5s and the phase 6s coming in, getting to grips with that unknown and what that all means is quite concerning. But then they've got to go and do it with all of their dealers. And they may have US dealers, EU dealers, Swiss dealers, Australian dealers, they've got to understand all of the different regulations that each of those dealers have, because they're not all the same. And so the BCBI framework does exactly that. It frames out what the regulatory jurisdictions should be doing in their view, and the regulatory jurisdictions then come up with their own flavour of what they want that UMR process to look like. And it's for the people that are impacted, the clients that are impacted, and the dealers that are impacted to fully understand what the requirements are. The rule of thumb with having a contention is that you go to the worst case. So if I've got EU rules versus US rules and there's something in there that's contradictory, you go to what is the most conservative. And so for clients, they're always dealing with the most conservative regulatory standards that they have to comply with.
And actually, just a question that just popped off into my head just now as you were saying that. Is there any particular regime which is being considered as the most conservative?
Not in my head. There's not. I've not heard people talk about that in any great ways. I guess the things that would be most concerning or the most concerning would be around intergroup swaps or intergroup trades, where under EU rules there's currently a derogation for another 6 months. I think equity options has caused a problem between US and EU rules and various other rules actually. So there's a problem there that needs to be reconciled through the regulatory bodies about whether they should be in or out. The other big contention that we see, and I'm having worked in Singapore, I'm very aware of, is the non-netting jurisdictions. So having to exchange collateral initial margin, particularly with non-netting jurisdictions, has got some different ideals through the US, EU, and through some of the Asian regulations and Australian regulations. So there are definitely some differences to be aware of. Being able to identify then who you're trading with and where they operate from, so the jurisdictions they're in, is really all important, and understanding where you're based. So if you're a client based in a non-netting jurisdiction and you are transacting with US, EU, Swiss, Australian dealers, you need to be very aware of the requirements. What are they going to expect you to do? Are they going to expect you to post initial margin to them? If so, then these are going to be things that you probably haven't done before because of your jurisdictional enforceability, the legal opinion in your country.
Yeah, that's one of the interesting things about this regulation. Unlike most of the things that have been implemented over the past decade, this is truly a global regulation, implemented by each of the individual countries and regions as appropriate. But it is a global combined objective to apply this to everyone in the markets, right?
Yeah, it is, and we're now in that stage where as the tsunami of regulation starts to hit the buy-side organisations, and they are now having to deal with some of the change that I guess the sell side have been dealing with for a period of time. It can become quite stressful, and I've written an article on this previously. In our opinion, the minimum requirements for a UMR project is 12 months. And you mentioned the wheel of pain earlier, and there's a reason for that. The reason it's called a wheel of pain is primarily because it does take 12 months. This is not just a click your fingers, sign up to a piece of technology and integrate it and you're all done. There is a whole host of planning, initiation of a project and planning into them what you look like today versus what you need to look like in the future. And clearly the future, you've never been there because you've never exchanged initial margin before on a regulatory basis. So what does it look like? And this is really where utilising the resources available to you, and whether that is a consultancy or a tech firm or different data points, utilising that and transforming the opportunities you've got for collateral management today become all important now. I think for the phase 5s and the phase 6s, they have a big opportunity to do something different with regards to their operating model and make sure that when their date comes around, the 1st of September, whether that is 21 or 22, that they have not just fallen over the line. Actually, they've got to the line and actually they've gone past it, and they're thinking about best practice, and they're thinking about actually how do we consolidate everything into, as you very well kindly introduced me, front to back, enterprise-wide operating model. Why do we have to stay in silos? Why can we not start interconnecting internally? These are the things that, in our view, at Margin Reform, people should be thinking about very, very clearly.
I guess as we got past the global financial crisis of 2007, 2008, and all of the regulations that are now being rolled out or have been rolled out, when they were all being formed and formulated in the ideas of regulators, the practical reality of it was that everyone was expecting that collateral was going to become a key part of the infrastructure, and that it only made sense to have this kind of enterprise solution for collateral. And in fact, I think there was one of the consultancies came out with a report in association with maybe Clearstream, as I recall, it was many years ago, that said there was an expectation that there would be a collateral guru appointed at each firm who would have oversight of the firm's resources. But we're almost 10 years on, and that hasn't necessarily played out. Why do you think that is?
I'm not sure in all places it hasn't. I did get asked once why I thought I was the collateral czar, which so guru czar, same thing. Why do I think it is? It's not a one size fits all discussion. I think if you're in a big deal or you're a big sell side bank, then I think that does exist. I think there are enough people there who really understand the story, understand where we've come from and the challenges pre-crisis to I guess just after there, so 2009, 2010, when people were looking at moving from LIBOR to OS discounting, understanding actually what was in the CSA really affected the pricing of the derivative and how you funded and liquidity and all that started to join up, and people really started to understand that. If I think back to where I was at that point, the optimization challenges became pretty critical. It feels to me like we've done a bit of a circle, and maybe this comes back to the politics, unfortunately, of some firms where, as you say, you can get one person in charge and everything gets pulled in. So you get your cash in there, your equities, your fixed income, and everything comes into that centralised pot, and you're able to work with that. And then something changes at the top of the firm, and all of a sudden the equities and the fixed income desk are not talking to each other again. And therefore it all starts to unwind. And I've seen that happen. I've heard of that happening at a couple of places where it's not necessarily doing the right thing not necessarily doing the right thing for the firm, but it may be doing the right thing for the individual and for their P&L. And so those conversations, I think, they evolve. There's peaks and troughs on it. If I think more about the buy side and what they're doing, again, how they're set up can be quite constraining. So if they're set up with a centralized function, then clearly much easier. If you're set up with different desks or different funds competing against each other, but they're all funded out the same pot, then there becomes this contention of, well, who's putting on positive funding, who's putting on negative funding, how are we allocating costs back? Do we allocate the costs back? Should we have a centralised book where those costs are just swallowed into a black hole? So all of it comes back to that operating model and understanding your operating model. And but they need to talk to each other, right? So the back office and the front office need to be totally entwined. There's no point in you going and optimising and repoing out in the front office if I'm at the same time posting that bond out as collateral. So there has to be this joined up approach, and that comes back to, again, sort of the visibility of what you can see. So having portals or inventory aggregation that actually shows you, right, well, what's the positions, what are the bonds I'm holding, the equities, or cash not so much of a problem, but bonds and the equities, I need to know that if it's going to be used, I'm not posting it out and just causing substitution problems and settlement issues and all the other good stuff that happens when collateral gets posted somewhere, either through repo, through to the clearinghouse, through to a bilateral CSA. Actually, that visibility and understanding the volatility of that piece of collateral is very critical, and where it is.
Right. Yeah, and I think you're right. So I guess what you said is it kind of depends on the individual firms involved and their infrastructure, their goals and objectives, but also maybe a little bit having to do with the people and personalities and their own silos. I guess, can we go back to phase 5 firms again? Because it seems to me that that's the most pressing issue where we are now. And you kind of described two camps: people that were working towards the September 2020 target and were all ready to go and sort of well advanced. They may be in one camp, and then there's the group that often we see firms, because of competing priorities, doing just enough to get by, just enough to comply with the regulation rather than really embrace it and change. And I think you described it before as kind of thinking about their actual operating model and trying to take a step up. So So I guess what should firms be doing now, and what are they doing now, and are there other competing priorities now? Because they're saying, well, look, that isn't happening this year. Go do something else. And what let's
Yeah, there are competing priorities, of course. Lots of the Phase 5 firms are going to have a repo and securities lending business, and SFTR and CSDR are incoming. SFTR next month for investment firms and credit institutions, and also then we move down to the buy side 3 months after that, and the corporate 6 months later. So that is definitely a competing problem. CSDR coming again February 21. So again, competing problem. People need to be on the front foot with that as well.
Look, I want to come back in a minute to some fascinating stats that I saw you provide on a recent webinar about people's experiences in March and April of this year. So crazy times in the markets, huge volumes of activity in the collateral space, and it'd be good for you to share some insights on that. But I think it's quite interesting that the coronavirus lockdowns that we've experienced has meant that many people have actually had an opportunity to step back and, whether it's for personal or work related issues, kind of reevaluate and reassess. And I think what I just heard you say is that those firms that have been far down the road and would have been quite robustly ready for September of this year now have a chance to go back, rethink it, and see if they can improve on it even further. And then obviously the other firms have been a little bit lucky in that sense, as they get a little bit more time to implement the whatever their end models end up being, right?
Have maybe not had to maintain the collateral model quite as accurately. Inaccurate is not the right word. Maybe they've not had to have the collateral model quite as well thought through. Right, the connectivity into the street via the utilities has not been quite as well versed or well picked up. They have not strategically assessed the options that they may have to get to that regulatory compliance yet. They may not have spent the time actually understanding the differences between third party and tri-party and what they do today. They may not have spent the time looking at, okay, well, initial margin, what can I post? Well, you can't post cash because there's very little way of anybody being able to consume it and segregate it immediately. So there are a few different avenues that the struggling Phase 5s needs to understand. Even for the Phase 5s who were ahead of the game, I think there is enough time now for them to spend or almost to retrench a little bit and go, right, do we still need to be going on this journey, this part of the journey? Is there a different way of doing it or a better way of doing it, because we've now got a bit more time? So actually going through your life cycle of, okay, we've got onboarding, we've got KYC and legal, we've got margin call management, the processing stuff behind it, the eligibility and the issuance and the calculation, SIM being the obvious one for initial margin, the valuations and reconciliations. Who's doing that for you? Doing it yourself, or are you outsourcing it? Are you insourcing it? Optimization, settlement, forecasting, reporting, all things that people should be thinking about. The optimization now, as we talk to clients, has been around, it's not just around optimization in the back end, it is about end-to-end optimization. So pre-trade analytics, understanding where you can execute, whether you can execute on a cleared basis or whether you can execute on a bilateral basis. These are good things to understand. The LCH have recently, in March, cleared out, had $1 trillion month of NDFs, which is currently not a mandatory clear product. So that's a great point in case where the industry is saying, right, well, I don't want to put these through the bilateral world because it's more expensive. And so this is people thinking about what actually happens in their day-to-day collateral life cycle to understand what's the best way of doing it. It's pre-trade, post-trade, and everything in the middle needs to be optimized. It's not just okay, I'm thinking about it and what I can post from a collateral perspective, whether that might be a bond or I can repost something in to post it out. There is a whole joined up approach to it. And so probably back to your much earlier comment around the collateral guru, I think people are having those types of people, having those types of that type of understanding in their resource profile is quite critical. because otherwise you are totally reliant on other people telling you what to do, or picking details up from your dealers about what they're doing and how they're doing it. And it's not necessarily the case that what is right for a dealer is right for a buy side. And in fact, I'd go as far as to say it's definitely not the case.
Yeah, so I guess human nature being what it is, there's probably not a lot of phase 6 firms that are thinking about their implementation, right? Or am I wrong?
If the numbers are correct and it's 800, then I'm definitely not having anywhere near that number of conversations. There are definitely phase 6 firms we're having conversations with who were pre-extension very interested in extending those conversations. That has clearly subsided a little bit because of the time frame. 30 months is a long time. While it might take a phase 1 dealer that long to get ready just because of the size and complexity of the organisation, the buy side are generally just a fair amount simpler, both from a technology stack perspective and also from a agility perspective, and being able to get stuff done a little bit quicker. So phase 6 definitely, I think, a foot off the gas a little bit at the moment, and I don't think that's a bad thing if they're retrenching to go, right, how do we want to do this, and how do we then future-proof better and enhance capabilities so that we're in a situation where the leverage that exists in the industry can be utilised, which is the right thing to do.
Yeah, so look, one of the things that impacts their ability to roll it out is the operational infrastructure, the technology, and all of that. But I'll tell you, in the sort of phase 1, 2, 3 sides of the business or side of the rollout, I will tell you, as a securities lending provider, it was impossible for me to get any time with any of my counterparties' lawyers to look at, negotiate, or renegotiate contracts. So while you can say, well, we've got some time on the operational side, is the legal aspect of this presenting a challenge, or could that be a time consumer as well to roll out?
It's a massive time consumer. It's definitely one of the most challenging aspects of the whole process. It for us, and my personal experience, when you've got CSOs and you've got over 2,000, 3,000, 10,000 CSAs, and you're starting to think about initial margin, then clearly there's a whole world of pain coming that you need to understand. So if we think about the buy side, who may have anywhere between 10 and 100 different counterparts they may want to trade with, you've got to really understand who your critical path counterparts dealers are, because you don't want to be in a situation where you're potentially having to negotiate all 100 of those or 50 of those if in fact you are not going to trade that often with them. So there does become a cleanliness point from a legal perspective, because there's a cost to doing it, of course. There's a cost to negotiating initial margin CSD, a pledge agreement. There is a cost to doing the custody side of things, and that's two-way, remember, because we are exchanging initial margin. So I have an account with a custodian, you have an account with a custodian. I need to have a relationship with both of them, as you do, because we need to check that the initial margin collateral has gone into the segregated account, and I can then see it and receive it in the event of default and that kind of thing. So there is a huge amount of work and focus on the legal agreements, and that is a significant part of the overall process. It's probably the biggest pain point. If we think about actually the journey from phase 1 actually to now, things have got considerably easier. So we started off, if we think about the IM CSD, or CSA in one word, CSD in the US, it was all brand new, right? The whole process has realigned over time through ISDA and through the working groups, the legal and docs working group has realigned so that people have actually been able to make it simpler. We've got different technologies out there, such as ISDA Create today, which is enabling people to get away from this red line, black line, two lawyers having two different ways of working in Word documents, which is frankly so old school that it's a disaster and continues to be a disaster. But the custodian side of things was at that point the 4 largest custodians, and that's going to increase. So people are not necessarily going to use those 4. They're not going to use some of the French security services teams. There's different custodian CSDs out in the US who are coming into the market as well. So you could end up actually having to have a relationship with in between 4 and 12, 14, 15 different custodial agents, which in anyone's book is a lot of management of relationships, particularly when it's not a relationship you have, it's just you're a recipient of that information. Being able to receive that information is something the industry has struggled with. Again, there are different ways of connecting into the industry to make that simple for yourselves. But yeah, legal documentations, legal agreements, very challenging, still very manual in certain parts. Takes a lot of time and a lot of effort, and frankly, the legal data. Anybody that's been in and around derivatives for long enough knows this. That legal data is totally. It needs to be golden source. It needs to be coming from the legal system, feeding into the collateral system. It needs to be feeding into pricing systems. It's so important in your derivative portfolio, in any portfolio, repos or derivatives, doesn't matter. The legal agreement is really, really critical. People have woken up to that, but again, it comes down to, do they want to spend the money on it? Have they got enough CSAs? Do they care enough about the impact from a FVA, CVA, P&L point of view to want to worry about the creation, for example, of a legal system that feeds into everywhere else? Or is it a case of we could just manually key some stuff in because it'll be fine?
Yeah, it'll be interesting. In a recent podcast that we did with Andy Dyson of ISLO, we explored the idea of blockchain technology being applied to documentation as an obvious solution to a clear and distinct problem. So you're saying that might also apply in this space as well.
Yeah, well, I listened to the podcast and I agree with it. I think, as you said at the time, it started off as a pricing conversation. How will this affect pricing? But the fact is that the proprietary side of pricing makes that possibly more. I think it makes it much more challenging to do. Legal documentation under ISDA has become so much more standardised in recent years, and this is pre-regulation. You now think about regulation, well, it's become even more standardised. So what is it you're negotiating? Well, you can't really negotiate anything too much outside of your eligible collateral schedules. And if you look at what's being posted between the biggest dealers, the phase ones and phase twos, well, it's all much for much. It's G7. I think last ISDA survey, it was about 88% of government collateral was being exchanged. So there's a negotiation there, and clearly some of the phase five might not want G7, but they might want to put in money market funds, for example, because that's what they can do with their cash. So there's the eligible collateral schedule negotiation is going to add some possibly some delays and time, some additional time to how people want to negotiate. But things like thresholds, daily calls, zero marked MTA, these are not negotiable. This is just what you've been given, deal with it. This is where you need to get to. So the sooner I think people can get to a point of saying, right, eligible collateral schedules, these are the golden terms of what we'd like. And if you're able to do that with the custodial agents as well, and actually have this ability to go in and pick the types of collateral you want online, somebody else just go in and say, yes, agreed, bang, agreement goes in something electronic, spits it out with electronic signatures on it, and you're done. The sooner that happens, the better.
Yeah, and so I think watch this. I think there's plenty of people focused on the issue, and I expect it'll be one that gets quite a lot of momentum and makes a really important difference. Look, I want to get on to other topics, but I'm wondering if you could just give us some thoughts on what happened in March and April. I didn't ask you to get any of this information together, so I don't know if you have it to hand, or maybe you can just sort of give us an overall sense of what happened during the rest of the market's chaos. Did that also manifest itself here?
I do have some statistics. So clearing-wise, the derivative world, credit derivative volumes, twice the monthly average, US single name and index swaps, 89% increase at the LCH. Non-deliverable forwards, as I said, had the first $1 trillion month at the LCH, which is an incredible number. Interest rate swaps, always an incredible number, but a record month again in dollars, only 2% up, but 8.8 trillion was cleared. But the most interesting stat, I think, actually, from an LCH perspective, was that the normal month of trade registrations, that is new trades put on at the LCH, is 500,000 on average. March was 800,000, so 300,000 more trades in March than in a normal month, which just shows you the amount of rebalancing that was having to be executed and completed through the derivative trading desks, both on the sell side and buy side. Eurex and the futures market was up 40% as well on the preceding 12-month average. So you take those two in combination, the LCH cleared derivatives plus the futures at Eurex, and they're just massive volumes. One-off, yeah, we hope so. The interesting thing, I think, is going to be the month end is coming into June and half-year end, where balance sheets tend to be a little bit more constrained as people are trying to improve or optically improve certain ratios. So we shall see what happens there. Bilaterally, so Acadia Soft, I've done a couple of podcasts on this and a couple of written articles about volumes and collateral size. So just let me run through a couple of those. Margin call volume was up 70%, so 1.78 million calls in March alone, just up from over 1 million in January and February. The average call size across everybody in Acadia jumped from 3 million to 9 million, although for the phase one firms that went up 5 times the size, from 12 to 60 on average. Total notional volume of the calls in March was 5.6 trillion. So just for bilateral derivatives in 1 month through Acadia, 5.6 trillion of notional. Massive, massive increase, obviously driven by the phase ones, the largest portfolios.
Yeah, I was completely blown away by the numbers in terms of both the volume expansion, but as you say, combining it with the ability for the market to cope with that, I thought was pretty impressive.
Yeah, the thing I found most interesting was the disputes. So dispute management has been a critical part of the industry since global financial crisis, and actually the statistics for March were that around 28% of calls were in dispute, which was very similar, if not exactly the same, to January and February, which I think is a real positive for the industry, and it shows that actually, despite the massive scale up in the volume of calls and the notional size, actually the process has been working. So for variation margin, it was fixed post GFC. For initial margin, the benefits of being used the SIM clearly, where people are using the same model, so they're able to analytically go through and understand what everybody else is doing very quickly. And that has proven to be a really good thing, I think. And that dispute stat, 28% of all calls, well, maybe still a little bit higher, almost a third of all calls are disputed. Actually, it's not. It's a lot better than where we used to be. And so I think it's a real positive. It shows collaboration, connectivity since GFC, and hopefully it continues that way as we go through into phase 5 and phase 6. And that's really where the critical path is now for making sure that we stay on that trajectory of it's around a third of all calls, and we're not spiking up to 50, 60, 70% again, which adds a lot of issues to capital and balance sheet impact when people are not focused on things like dispute management.
If there was one piece of advice that you could leave with people, or one observation that you could leave with people about UMR and how to approach phase 5 and phase 6, what would you say to them?
Phase 5, don't sit on your hands. Don't wait for clock to keep ticking over. Utilise the remaining half of 2020 to analyse where you're at, analyse where you think you need to be, understand what the gap and the risk is on the start and the finish line, and then prepare accordingly. I don't think there is so I've said it a couple of times, I don't think there's a one-size-fits-all. It really depends on your starting point. The end point is fairly familiar and similar for everybody, right? You've all got to do similar things and same things. But there are a number of things you can do around self-disclosure, talking to your dealers, distilling the rules, understanding where your clients are, understanding things like tri-party and third-party and the differences between them. They're not necessarily going to drive your whole project, but they're going to start building up that internal understanding. So utilise the time you've got through early engagement, utilise the time you've got through internal communications, making sure you're building the team together who are going to help with the compliance delivery, provide maybe internal working groups and training sessions to get people more up to speed with what is coming in 2021, particularly if you're the guys that the clients who are behind the curve. And these are all things that naturally margin reform can help with. But that is what I would be doing if I was in a buy-side institution who are phase 5 today.
Right. Okay, thanks for that. So I want to move on now to something where, frankly, I've only heard you use this phrase, and that is clearing optimization. So we talk a lot about collateral optimization, but what do you mean by clearing optimization?
So I don't look at it really as a bit different to any other optimization. It's just a different part of the business. So again, it comes back to, do we have a joined up end state? So from an optimization perspective, is someone looking at everything that comes in and out of the firm? Well, they clearly are, but that's normally the house assets. Then you've got your client assets, which cannot be mixed up for obvious reasons. You're not optimizing in with the house. So clearing optimization for us is looking at best practices, internal cost of capital, efficiencies in front to back offices. If you're a client, the service levels you might get from your clearing broker, your ability to access different CCPs through your clearing broker, really understanding then how you take all of that into account in relation to, if you're a client, understand how you take all of that into account in relation to the collateral you might be posting to the clearing broker to the CCP via the clearing broker, and is there a way to optimise and be more efficient in what you're doing? Normally we think there is, and based on the number of conversations we've had in this space in the last couple of months, there's definitely been a challenge where the relevance of this is starting to be understood a little bit more. Certainly there's been a couple of reasons why. So if you think about Brexit, for example, and what's going on with regards to CCPs there, then there is going to be a division at some point of where people want to clear, depending on where they're based. If you're based in Europe and you're trading euros, what's the reason to go to the LCH all the time or to go to somewhere else? On the other side of that, if you're trading dollars and you're trading sterling, why would you go to Eurex? So these are some of the things I think people are thinking about. Is okay, where should I be clearing? Now, clearly, liquidity and compression and all that sort of stuff is really, really integral to making sure you are clearing at the right place, and your clearing broker can offer you the clearing capability that you want to be able to manage your portfolio, to compress and to do everything you need to do around initial margin optimization. The reality, we think there's three angles: is the clearing brokers, and one is clearing brokers and how they support their clients. The second one would be around clients who are already clearing, and the how, who, and what they're clearing with and why. And then the third one is maybe those who are not yet mandatory clearing, but may need to in the future because they are impacted by UMR, and therefore that is defined to be more expensive than clearing, or there's not a regulatory requirement yet for them to clear, so such as pension funds, for example. So there's different ways we're looking at this, and depending on who we're talking to, we're having some interesting conversations. And it's not to say that one clearinghouse is better than another or a clearing broker, but there are different levels of service and there's different capabilities at different CCPs, and that's really what we're trying to help determine for the clients and for the some of the clearing brokers we're talking to.
So do you think that there will be winners and losers out of this? Do you think that there will be realignment, or is it really just understanding the scope of the offerings and the strengths and weaknesses of each?
There's a bit of both, I think, where the winners and losers maybe not. I think everyone there's a huge amount of CCPs in the world, right? There are tens of. So I do think clearing brokers are less inclined these days just to go, we're going to go and be a clearer at this clearinghouse. They need to understand. They don't want black boxes and initial margin models. They want to understand the model. So those types of things, I think they've always been there, and that will continue. But if I think about if I'm a client, what am I concerned about from a losing perspective? Well, if I've only got one clearing broker, for example, and that clearing broker decides to exit the market, where am I left? So I'm a loser in that situation. And we've had a recent example of this where NatWest have decided to exit the market in their last clearing. And they had, I think this is in March, they had 150 clients. 150 clients have got, if they haven't already got another clearing broker, will need to go and find another clearing broker. Okay, so there's a whole process there of offboarding, onboarding, porting, building a relationship again. And so that would instantly cause you a lot of work. Winners and losers, difficult to say, Roy. I wouldn't want to define what makes you a winner or what makes you a loser. I think if I'm a client, then clearly client service is something I'm interested in and getting value for money. If I'm a clearing broker, then being able to provide clients my service makes me a winner. Losing wise, there is going to be some change. I do think there's going to be some change in what happens post Brexit. I don't know when that change will come and in what sort of volume. But there is going to be some change naturally. I just think the political environment and the regulatory environment will ensure there is change, even if it's not a choice.
Yeah, and I think your example of brokers getting out of the business is actually quite an apt one. I think there's been quite a lot of departures from the business, hasn't there? In terms of firms offering the services.
Yeah. Yeah, and it's not as easy for some of the smaller firms. If you go into the tier 3, tier 4 to banks, then they're not operating with the huge, massive dealers that we know are in the clearing business. They have to go and speak to the dealers who are maybe tier 2, phase 2 in UMR world, but speak to them about, okay, what service can you offer me? So this balance sheet impact of clearing has historic balance sheet impact has changed a little bit because of the way we settle now, but there has been a big challenge in maybe sometimes some people being able to access that market and access the clearing brokers, or certainly to access more than one clearing broker. The other things from a client perspective, the ESMA came out with a fair, reasonable, non-discriminatory and transparent best practices document recently. I think that was issued last week. Another slab of reading for us all to do, but our clients getting the service they expect, and is that really everything that ESMA expects, and is it what the client is getting is two different things, I think, on some occasions. But the point is there's always a review to be had. If you think about how long clearing's been in place now, it's 4 or 5 years, I guess, maybe longer, in fact, from a regulatory perspective. How often do people go through and actually look at the service level agreement they've got, look at actually what they're doing operationally, look at how they're interacting with their clearing broker and say, do you know what, we haven't reviewed this because we've got competing issues. These are some of the things that we're trying to initiate in conversation. Say, well, you really should go and review this. If you haven't reviewed it for 3 to 5 years, why not? Okay, it's the consequences of doing nothing sometimes outweigh considerably the consequences of doing something and actually maybe not getting as much of an improvement as you would have liked. But generally speaking, I find that if you do nothing, it's going to be worse than doing something and not getting quite what you wanted.
One of the things that we talk about is this collateral universe reaching a much bigger scope now, right? Everyone of any size is going to be involved in the collateral world, right? So I guess for those firms, many of whom have never had to deal with it before, is this really a core function, or is it ancillary to what their main purpose in life is?
In my view, it's a core function, yeah.
You mentioned, for example, pension funds, right? Pension funds, are there to generate returns over the long term for their future pensioners. Managing collateral doesn't seem to be top of the agenda for them, but it's kind of being forced on them.
Yeah, I would agree that it has been forced on them, and it is regulation that is forcing them to think about what they need to do and how they need to do it. That being said, there is a level of internal good governance and doing the right thing that every pension fund and every client, every counterparty wants to be seen to be doing. So, for me, is it a core or ancillary activity? It's definitely a core activity because you're all doing it. Everyone is exchanging collateral somewhere along the line, and whether that's completely regulatory or not, as of yet. Well, you're exchanging collateral on a bilateral basis, or if you're not exchanging IM, you generally have a variation margin document in place, and therefore you've got something going on. If you're a large organisation with multiple subsidiaries and 1 or 2 branches, that is very different to being an organisation that's got one trading jurisdiction. Okay, so if I'm trading out in multiple jurisdictions, I've got lots of different things going on. I've got different legal requirements, different compliance requirements, different regulatory requirements, and that makes things complicated. That's when you potentially need the overall collateral view. If you've got a very simple operating model, you still need to have a collateral view. It doesn't need to be as complicated. It still needs to be as connected, but it's still core because there's still cost to it and there's still a process around it, which if you get wrong, it's irritating for people. And okay, maybe for some dealers it's not an issue, or sorry, for some clients it's not an issue for some dealers, but equally you want to be in a point where you are with the rest of the market. You don't want to be an outlier here. So I think the market is moving towards it being a core activity because regulation is stating that. The conversations we're having, where if you think about cleared repo as a product, that's becoming more of a product for everybody to access. So that is, again, making more of a core product or making more of a core product for the industry to access liquidity in times of stress. So it all points towards the market becoming more understanding of collateral, trying to deliver a more front-to-back approach, trying to get more technologically advanced, trying to get better connected, trying to improve process timing, trying to improve settlements, and if settlement fails, and CSDR is going to do that as well. But you can't just sit on the sidelines anymore and hope it's all going to be all right with collateral. It's not just as easy as throwing it at the wall and hoping it sticks. It's too complicated for that.
One of the things that you touched on earlier, you had mentioned CSDR, and often when I'm involved in conversations on CSDR, it's really more about getting securities back and avoid on recall and avoiding buy-ins, the potential buy-in regime that applies to that. Where does CSDR fit in with UMR?
Posting something out under a collateral arrangement, a CSA or a CSD, and then your repo desk trying to call it back, you're not getting it back, for example, because you might be on third party, it's a little bit more manual, and then not being able to settle in time and having to receive a penalty for that. These are the types of things that are going to cause or could cause problems in the future. There was a lot of industry advocacy on actually whether the exchange of collateral under a CSA, CSD was meant to be impacted by CSDR. And I believe that certainly advocacy is still ongoing. The advocacy for CSDR, the European CSD Association wrote earlier in the month seeking a further extension, and in their words, possibly by 1 year longer. I don't know what the possibly meant. Maybe it's 1 year or 2 years, but it remains to be seen what that actually looks like and the response they get on that. So from a UMR linking into CSDR perspective, it's about just the visibility of collateral, the usage of collateral, how your front office and your back office or your optimization team are talking to each other. Do they all see the same data? Have they all access to the same data? And if so, is it real time? Is the data real time? Does everyone understand when that collateral is no longer there, and therefore there may be a challenge, or there's a reverse repo going back or a repo call coming in, that you're not contradicting your own algo internally between the front office and the back office by doing different things.
Right. So it's the same kind of issues. So I was more concerned or my customers are more concerned in terms of getting recalls in to avoid buy-ins. And really that's just reputational risk on that side of it, even if they get economic compensation. You're saying it's the same sort of issues, whether you're buy side, sell side, large, small, it's the same across the board.
Yeah, exactly. There's like all things, there's when you deal with clients or with counterparties, there's a level of, okay, I'm happy to do this for you. If somebody's going to start implementing 10 substitutions a day because I'm not on tri-party that are manual, it becomes quite frustrating, right? And you're just leaving yourself open to failure, operational risk in failure sense, and also to settlement risk in failure sense. So there comes this level of, yes, I'm no longer happy to do that for you. So stop posting me collateral you want to use elsewhere and post me something you don't want to use elsewhere. So optimize your client almost as much as you're optimizing your pool. Don't irritate people by doing something that is good for you but bad for them.
Cool. Look, there's two more things I want to touch on briefly before we wind it up for the day. One is, let me go back to the Wheel of Pain again. I just love it because everything seems often to be a bit of a wheel of pain anyway, and I think it could be a podcast subject in its own right. But can you just give us a 2-minute overview of what do you guys mean by the Wheel of Pain and how is it applied?
Yeah, of course. So the Wheel of Pain, we may have T-shirts made up at some point. I think Chetan loves the idea of T-shirts with it on. The Wheel of Pain was really us sitting down at the outset of UMR, or margin reform and UMR, and how we could support clients, and saying, right, when we were going through this process at my previous shop, and I was leading the overall program. from a front office and a back office and a technology perspective, and what were the things that we went through, what were the biggest pain points, what were the biggest challenges, what did we sit down and spend time actually going through from an analytical perspective to determine where we were going to end up in the future. So we've listed out 9 areas where we think these are the biggest pain points, and they're almost segmented into, okay, well, you've got the first piece, which is what I talked about earlier, getting ahead of the game a little bit with your self-disclosure to market and your client engagement, and distilling where your clients are jurisdictionally wise, and then what you might need to do to comply based on that regulatory jurisdiction. Moving then more into the legal analysis kind of work and custodial onboarding, which, as we've talked about, very documentation heavy, but equally very critical to get right because of basis risk and pricing risk and settlement risk and collateral risk and all the other problems that legal data can bring you. The second or the third things that we linked in together were technology, operations and optimization. Because technology, and we haven't talked particularly about the ecosystem, there is a massive ecosystem out there now. There's a lot of vendors in the market who are able to provide solutions that mean you no longer have to build. You can buy, and frankly, anyone building in phase 5, phase 6, I do question why. They may need to do add-ons, they may need to do some integrations, but there are enough great vendors out there right now providing the facilities for you to be able to get compliant with UMR in a much easier way than we did in phase 1, where, for example, we had new collateral systems, new legal systems, new initial margin models. Everyone's going to have new initial margin models, but new process, new governance. That ties into then the operational side of what happens and design and implementation, because you've got to remember the guys really who will suffer this at the end of the day, the guys in ops who will have the new process. There's going to be two new calls every day, initial margin in, initial margin out. They're going to have the relationship with the custody. They're going to be looking at potentially at the long box to understand from a tri-party perspective what's in, what's out. If they're doing optimization as well, things just got slightly more complicated. They'll be talking to the Treasury Department and so on and so forth. Optimization we also have on here, although it's not a regulatory requirement to optimize, it's a necessity. And I've talked about the front to back optimization, pre-deal versus post-deal, and the analytical side of that. And that we believe is one of the key requirements of making sure that journey you're on and bringing out the process that you want to future-proof. If you haven't got optimization in that, then you're not future-proofing yourself. You're just falling over the line. And that's really why it's in the Wheel of Pain. And the last one is around the IM model. So here's the SIM is the model of choice. I don't see that anyone in phase 5 or phase 6 is going to do anything different in that regards. There would be very limited success, I would think, in doing anything different to that. But the point is, you don't have to build the initial margin model yourself anymore, as we did in phase 1. There are, I think, last time I looked, around 30 different providers of the SIM to the industry. Now, clearly there's different levels of expertise there and different levels of client sign up, so you need to be careful. You don't want to be taking on a lot of delivery risk.
As you were going through each of those elements, I could see how they're all really critical things to be concerned about. But what I'm missing is the fun bit. I'm not certain we've covered the fun bit, which I suspected might be a little bit of a challenge earlier on. But I suppose that there are people that do think this is fun. If they aren't in the majority, I wouldn't be surprised.
Yeah, look, the fun bit's when you're in the middle of it, right? That's the fun bit. While it can be a stressful time, the fun bit is actually getting things right. It's saying, right, okay, we've got this problem. You sat down with your trading desk and your compliance team, your legal team, and ops, and actually you've written out this is what we think is going to happen, and everyone then just starts shipping into it, and you come away with something where you go, okay, that makes a lot of sense. Now, maybe that's not always fun to everybody, but it is solving the problems, and you're having to solve a significant amount of problems, and just by going through the Wheel of Pain. That's without all the ancillary stuff that you may have pop in because you've got a slightly different model to the one I've previously been through or anyone else has previously been through. But yeah, it's a great connector, the Wheel of Pain, because it enables us to talk to different teams in different organisations about, okay, what's the impact on you? Because it's not just this impacts margin operations or this impacts front office, it impacts everybody.
I understand you are going to be on yet another webinar on the 2nd of July. So usually you're a guest commentator on these webinars. but I understand that this one is going to be different. What is it? What are you trying to do? And tell us a bit about it.
Will do. So it's our first webinar at Margin Reform. As you say, 2nd of July, 3 p.m. And the plan is to introduce Margin Reform to those that haven't seen Chess on a podcast or a webinar or an event at some point. Talk about what we do, who we are, what we do, and do that in tandem with why we do it and who we do it for. So to focus on our professional services and what we do, and they're obviously on our website as well, but to talk about those, and then just to focus again on UMR and go into a little bit more detail about that phase 5, phase 6 extension, and how people can utilise the additional time better or approach the regulatory compliance requirements in a different way as part of a more extensive collateral margin strategy. So the points we talked about in over the last hour or so, just actually helping them understand that in slightly more specific form. With probably we'll go into 4 or 5 different bullets about what that looks like, and these are things we think you need to focus on over the next half of the year. We haven't yet sent out anything. I think we're due to send something out tomorrow, so give everyone over 2 or 3 weeks to work out whether they can make it or not, but we will be open to everybody as far as I'm concerned. Very happy to make contacts with people and initiate discussions. That's the fun bit as well, is catching up with new people.
Great. Well, listen, we'll make certain that there's the details to that posted on the show notes by the time this gets published. So, Sean, that's great. We've covered a huge amount of topics. What message would you leave with listeners?
Be broad, be bold, be expansive. Think about what you're doing. Don't go in with your head in the sand as you may have done previously. Look at Collateral as a product. It is coming into its own realms of being a really, really important part of every organisation. Every organisation is impacted by it, and start to, I guess, wake up a little bit and think about how you can change internally and externally to improve your processes, be more efficient, and work on that, and don't stand by and let the time you have pass you by.
Great. Well, thanks very much. Thanks
for having me.
Great. All right, we'll catch you next time. Maybe we can get you to come back sometime in future and carry on with some of these, or maybe give us an update on how things are progressing.
Sure, Roy. I'd love to do that. It's been my pleasure. Thank you very much for having me, and thank you for listening.
And that's a wrap for this podcast with Sean Murray. He's managing partner at Margin Reform. We talked in depth about several topics, and let me give you my 2 key takeaways. I guess the first one is that for UMR, firms in 5 and 6 have an opportunity not simply to defer implementation, but to turn it to their advantage. They can re-examine what their existing plans were that were maybe near to implementation, and see whether there's any way that they can enhance and improve or advance their proposed operating models. Or, look, at the very least, they've got more time to get it in and get it right. We also discussed clearing optimization, which, as I said, is a phrase I'm not familiar with, so that's good to hear it being used in the proper context. I guess Sean's point was that clearing optimization is no different from any other kind of optimization. Check the service providers, check what business you're doing with whom, see whether the providers are giving you the best mix of services that are specific to your needs. And look, if you haven't tested the markets recently, maybe it's time you should. I'll be including relevant links in the show notes to several of the items that we discussed on the show. And don't forget the Margin Reform webinar on 2nd of July. Hopefully by the time you read this, the details on how to register for that will be included as well. In our next episode, I'll be joined by one of my Peirpoint partners, John Arneson, and we'll be considering the life cycle of securities lending transactions. We want to provide you with topics that you want to hear about. So if you have subjects you want to learn about or guests that you'd like us to have, send them through to us. Our contact details are, again, in the show notes. If you want to hear more podcasts, please subscribe to the podcast and tell your friends. You can find us at www.peirpoint.info. You can find us on LinkedIn and Facebook as Peirpoint Financial Consulting and on Twitter as Peirpoint FC. And again, all of that will be in the description. I'm Roy Zimmer-Hansel. I'm your host, and I look forward to catching you next time.